In our previous class, we had talked about valuations of firms. I think we did the introduction part, and of course, we ended up doing a question here. I think it was, and of course, I also shared, but being that it was recorded, I just felt we could do another one. We have an engagement, can call it a one-on-one interaction, so that maybe if there is a question, we see how we address, but of course now using a different question. So I've forgotten which past paper this was. Yeah, but of course we did this as well. And of course, I even shared the results of what this should bring, but maybe as part of engagement with the learner, and of course, maybe answering questions. It's important that we do another one just to corroborate that which so far we have discussed as far as valuations of firms are concerned. So maybe I'll ask Angel. Is it Angel or Angel? Angel Mwashi. Yeah, maybe I'd ask Angel Mwashi to read for us if she's in the building. She had asked us to. Ruth, you are writing on my screen. Yeah, Angel had asked us to postpone the class briefly for her that she could join. I can't see. If maybe you are in, I can see you, then I can unmute. Okay, or anyone willing to read for us, please? Mercy? Hey, the questions I've shared in group. Unless you're not in our group, I've shared. Anyone? Mercy, can you read for us? The questions I've shared in our group, so just check there. Mercy, you can unmute and read, kindly. Mercy, we can't hear you.
Okay, good evening.
Evening.
Okay, question 24. M Limited is currently making a bid for N Limited. The following information has been provided to enable you to determine the various prices that M Limited can offer the stockholder on N Limited. Statement of profit or loss extract for the year ended 31st December 2022. Revenue, and the cost is 100,000. Cost of sale, stroke administration and distribution cost, 80,000. Earning before EBIT, 20,000. Depreciation and amortization, 4,000. EBIT, 16,000. Interest, 2,000. EBT, 14,000. Tax at 30% is 4,200. Net income, 9,800. Dividends, 4,000. Retained profit for the year, 5,800. Retained profit balance brought forward, 14,200. Carried forward, 20,000. And then there's the statement of financial position as at 31st December 2022. Non-current asset 56, current asset 24, total assets 80,000. Ordinary share capital 16, retained earnings 20, total equity is 36,000. Non-current liabilities, long-term debt 24,000. Current liability 20,000, total liability 44,000. Then the total capital and liability, 80,000. Additional information. Number one, currently N Limited has 4 million shares with a market price of 15 per share. Number two, the current market price for N Limited debt is 24 million. N Limited financial statements are expected to grow as follows. Number one, revenue at 10% for the next 5 years. EBIT stock revenue margin is expected to remain the same. Depreciation stock amortization to grow at the same rate as non-current assets, that is 15%. Interest expense at about 10% of previous year long-term debt, which will grow at 20%. Retention rate is 60%. Any balance figure in the forecast statement of financial position is long-term debt. Number six, current assets and current liability will grow at 10%. The applicable weighted average cost of capital is 18%. Assume that the free cash flow to the firm of Unlimited will grow at 3% from the year 2028. Required, determine the value of Unlimited using the free cash flow to the firm model. Finished.
Thanks, Mercy, for that. So I think we can proceed to solve it. So of course, I think we have talked about the procedures or the steps. So we can just go straight forward. We said the first thing is to forecast our financials. So we can talk about the forecasted. We can either do it. I think we can even, can we do it up here? No, I just prefer we just copy these to paste Chini so that we do them down. I think that would be easier. So we can just paste them here. Then we talk about the forecast. We can just call it financials. So we have the statement of profit or loss. Of course, we are starting from 2022. So we have forecast financials. Because I think we have talked about how to forecast our financials. I believe at this point, we should not be having any challenges as far as forecasting is concerned. So we proceed. So basically, the results for 2022 here I'd just like to help us do our projections, but McQ, they're not going to be part of the data we'll be using for the computations, because usually we are more interested in the forecasts and not the current data that we have. So basically, we look at it above from the data sets that we currently have. So basically, for 2022 is more of just a reference. Yeah. So our revenue is expected to grow at 10% for the next 5 years. Yes. So if our revenue is growing at 10%, then we expect to have a revenue of 110% times this that we have here. Good. So we have 110%. Then, of course, we simply drag to the last. I think we need to have also 2027 here. Yeah. So basically, we have that. We've done that for the next 5 years as per expectation, 110% on account of the 10% increment. Then we move to note 2. Revenue margin expected to remain the same. So basically, if our revenue margin is expected to remain the same, then what needs to happen is that we need to know what is this revenue margin that we're talking about currently that we expect to remain the same. Yeah, so maybe you can give me what is our revenue margin that we have as at 22. And of course, that is what we are going to apply throughout. So we can start at that point. So you can compute your revenue margins. What is the revenue margin? As per your computations. At times I do want us to have the responses such that then they are not purely mine. Yeah. Because maybe if I'm doing them by myself, I can be a little bit fast. At least if you also participate, it can control my speed a little bit. Yes, otherwise, if I'm to do them myself, then I'll go at my pace, which may not be the standard pace that we so far have. So I'm seeing you are getting 20%. Of course, I believe the 20% is 20,000 divided by 100. So that is the margin. So our margin is usually gross profit over our sales. And of course, if we expect it to remain the same, then it means we can fill our EBITDA with that. So basically, our EBITDA should be 20% times our revenue. 20% times our revenue, of course, across. We basically have 20% of our revenue. So if we have our EBITDA, we can determine our cost of sales. So of course, my cost of sales will be 22 minus 110. Yeah, that would be my cost of sales. So that I have the results there as my cost of sales. So basically, you start with EBITDA, then you compute your cost of sales by taking revenue minus EBITDA. Then the next thing we so far have is basically our depreciation and amortization. So depreciation growing at the same rate, that is 15%. So depreciation growing at 15%. So that is the growth. So of course, if it's growing at 15%, then we expect our depreciation to be 4,000 times 115%. That is a 15% growth. So of course, 15% increment, we simply do the first one, scroll across. Then we can determine our EBIT. So of course, our EBIT would be EBITDA. Then we adjust for that. Then from there, we can compute our interest. And of course, maybe that is where I'll need a little bit of interpretation on what our EBIT, what our interest figures or computations would be, as far as those notes that we so far have are concerned. So in note 4, yes, that interest expense at about 10% of previous year's long-term debt, we will grow at 20%. So maybe you can tell me what your interpretation of that particular note would be. Yes, interpretations for that? Note 4. Okay, it's a little bit challenging. Anyway, all of the responses are making sense. But now I'm seeing some are saying that it's the long-term debt that is growing at 20%, and the interest is 10% of the last year, of the previous year. So um hmm, I had a discussion with our evening class students, and they also had different opinions. And of course, maybe for all of the opinions, they both look right. None looks wrong. So how will note 4 impact our note 5? So do we just project our long-term debt, the growth at 20%, take our interest to be 10%, or how should it be? Because now if you're told the balancing figure or any balancing figure is long-term debt, then you see it will be affecting our workings. But either way, it's okay. If you're saying interest expense is 10% of previous long-term debt, and the long-term debt is growing at 20%, then fine. Let us take that approach then. So we're saying our interest expense is negative 10% times the previous year's long-term debt. So what we had last year was 24,000. And of course, as usual, we can just drag across such that then when we have the figures of our long-term debt, they'll automatically recompute. Then we can have our EBIT. I think EBIT would be straightforward. Then we can look at our tax. It is 30%. 30% times 15,000. So we can look at our net income. Of course, our net income would be 15 plus 45. Then we can look at our dividends. I think we were told that the retention rate is 60. It then means they are paying out 40% as dividends. If you are retaining 60, then you are paying basically 40% as dividends. It's basically just 40%. Then we can have our retained profits brought forward. So basically our retained profits brought forward is what we carried forward from last month. I think that one we had agreed on. So what you carried forward from last month becomes your retained profits here. So basically, I think that marks the end of that section. So quickly, we can look at our statement of financial position. So we move to our financial position. So on non-current assets, I think they were growing at 15%, not 3. Non-current assets, 15%. So we're talking about 115 times 56. Then current assets, I think they were growing at 10%. If I remember that not clearly. Yeah, current assets, current liabilities growing at 10%. So we have 110% times the current assets that we so far have. Then of course, our ordinary share capital, we expect them to remain the same. So we expect our ordinary share capital to remain the same. At 16,000, and because they never talked about any note talking about that. So our retained earnings would be the retained profit carried forward from our P&L. Of course, we expect it to move a little bit after we have adjusted for our finance cost. I'm not sure if it will work out with that finance cost, but let's see. That note was not straightforward. Then of course you said long-term debt was growing at 20%. So 20, that will be 120 times our long-term debt. So 120 times 24,000. What, 20% growth? Huh? A 20% growth. Was it 20%? Let me confirm again. Okay, 20% growth is that. Then our CL current liabilities, I think it was 10% as per the second last note. So we expected them to grow by 10%. Then total liabilities will be 22 plus 28 here. I'm really interested if this balance sheet of ours will balance the way it is. So we expect to have these two. So long-term debt should be the balancing figure. So my question again would be fine. I could delete that long-term debt, but if we were talking about the 20%, 10% of the previous years, so we can, okay, fine. I think maybe I'll be persuaded a little bit. So we can have the balancing figure here. 9,800 minus 64. So that here we have a balancing figure of 26,500. Okay. Maybe that makes sense. But now, if it is 26,500, what is the effect of that note we were talking about, where our balance, our retained earnings we expected to grow by 10%, by 20%? Because this one I can do, yes. But now, what is the impact? What will be the impact of that note, where our long-term debt is growing at 20%? Or that is the expected growth, but maybe it is not the actual growth that we so far have realized. Vincent has something to say. You know, I'm also being confused. Vincent, maybe you can unmute and tell us.
Yeah, can you hear me?
Yes, we can.
Yeah, there's something here that's a bit hidden, which I thought I needed to share with Tim. You see, in the first column for year one, if you take 10% interest on the previous year's long-term debt, that
Where,
should give you, that alone is going to give you retained profits.
Yes.
Carried forward, isn't it?
Yes, it gives.
So you bring that retained profit to our statement of financial position down there.
That's what we have here.
Correct. So when you bring that, you are able to compute the long-term debt.
So then, is it the approach I'm taking? Is the approach I'm taking right?
So that's correct.
Okay. Meaning.
So then,
to you.
yeah. So then again, you go back, pick retained profits
for year two.
For year two. Bring it down.
Then we get the balancing figure here.
You get the balancing figure.
Okay.
So that actually worked for me, and that's how I got it.
It's okay. Yeah. Sir, thanks for sharing that. And of course, maybe that's just a little bit of understanding what the question really needs. At times, maybe there is a question that could be a little bit straightforward. It's something you know, but the wordings may make it a little bit difficult. So I think he's supporting what we've done, that our balancing figures are the long-term debts. And of course, we just need to compare our total assets that we have, total assets against the total liabilities that we have. And of course, the balance that we are maybe missing, we treat it as a balancing, as long-term loan, which I think we have. So I think that's okay. So maybe you can summarize maybe in 2 minutes, then we do our free cash flows, then we move to the valuations. I think we are left with maybe 2 or 3 things, then we call it a day. So we can determine our free cash flows. So of course, we had said our free cash flows were starting from the net income. And of course, we are interested in 2023 moving forward. So our net income in 23, I think we had computed it as 10,500. That was our net income. Yeah. Then we had talked about the adjustments we needed to take. And of course, one of them is depreciation. And the reason being that depreciation is an non-cash item. Yeah? So in as much as we had deducted it here, it should ordinarily not have been deducted. So we have to add back our depreciation, which is a non-cash item of 4,600. Then I think we said after depreciation, one of the things that comes the other thing that may come is capital expenditures. So capital. So we could be having capital expenditure. And of course, for this case, the way for us to determine our capital expenditure would be in terms of this movement. Such that in 2023, we are making the difference. Last year we had 56, this year we are closing with 64. Means we have invested, I think, a further 8,000. Basically, that is how we take that. So it should be 56 here minus 64. So basically that increment would amount to our CapEx, our capital expenditures. And of course, that should be deducted on account of being an outflow. Then from there, we look at the changes in our working capital. So we start with our current assets. So of course, for current assets, we had said if our current assets is moving from growing up or maybe moving from 1 to 2, then that's basically an outflow. So increases in current assets are outflows, an increase. But for this case, we can see that it's also increased, meaning we need to recognize that a particular outflow by maybe saying that we acquired more. So an outflow is of course deducted. And of course we drag to the last item. So current liabilities, it is going up. I think if our current liabilities were going up, that was an inflow. So it should be 22 minus 20 or an inflow. Yeah. Of course, if you have the two, then we can drag across. So of course, for capital expenditure, we've said we look at the movement. Yeah, the increment from year 1 to year 2, that would be the amount that has been invested in CapEx. Then of course, we look at our current assets and current liabilities by making a decision as to whether it is an inflow or an outflow. Of course, we know an increase in current asset is an outflow. It means you purchased more of assets. And of course, an increase in current liabilities is an inflow. Yeah, so you look at it from that particular angle. So maybe we need to be quicker so that we determine our terminal value at the end of year 5. So for terminal value, maybe if you remember, we said the terminal value would be the year 5's cash flows times into bracket 1 plus the growth. Then we divide everything by if you were to divide everything here by cost of equity, I think minus the growth rate. So basically from here, we can determine our cost of equity. Remember, WSEC, which is the weighted average cost of capital, is usually the cost of equity, weight of equity, cost of debt, weight of debt into 1 minus T. Yeah. So how will that then feed into our workings? So we know what how would we make our cost of equity the subject of the formula? Because we know we have our WCC. Our WCC tumepewa is 18%. Basically, we have an 18% here equal to cost of equity, which we don't know, but we know the weight. So it is times the weight. So the weight of equity here, is it even probable to determine the weight of equity here? Yes, let me see. Yeah, so basically we have an equity of 16,000 and a debt of 24. Yeah. So if the equity is 16, then it then means the weight of equity would be 16 here divided by 40. Of course, 40 is now the total, so 16 plus 24. Of course, plus the cost of debt, which tumesema ni 10% times the weight of debt, which will now be 24 over 40 times 70%. 70% on account of the 1 minus T. So I think this is the right approach. Yeah. So WSCC of 18% should give us the cost of equity times the weight of equity, which is 16 over 40. Because if you look at our balance sheet, we have a 16 million. And of course, the debt is 24. Yeah, the debt tumepewa hapo is 24. Yeah, over 40, and of course times 70%, which is 1 minus T. Therefore means that our cost of equity would be 18% minus into bracket 10% times 24 divided by 40 times 70%. Yeah. And of course, that would give us 16 over 40 of the cost of equity. Yes. So if we collect like terms, we take this to the other side, we deduct. So it is 18 minus 10 times 24 times over 40 times 70, giving us 13.8. So basically 16 over 40 cost of equity here is equal to 13.8%. Meaning then for us to determine our cost of equity, then it would be 13.8 times 40 over 16. No, this is unrealistic. It can't be 35%. Yeah, pana. That one I refuse. Yeah, approach is easy to pair answer. So multiply by 40 over 16. Hapana. No, this can't give us the answer. Cost of equity can't be 35%. No. That is unrealistic. I refuse. It's not making sense. Yeah, it can't be 35% because from that computation we are getting at 35, which is too high. That is too high, and I think we've done it right. So I think in this case, we can take our cost of equity to be the weighted average cost of capital. The current value of equity is 4 times 15. Mm-hmm. Let me see. Yeah, I think we can use that WCC as the cost of equity. As opposed to this approach, I think if it is impossible for you, it's quite difficult because if what I'm getting, I don't think it will reduce that value to lower than 20%. Yeah, so I really doubt it. So I think what we need to do, as Godliver is saying, then we can use work. I think so. Yeah, so I think we can just use the work as it is, meaning we have 69 here. And of course, maybe we can start with the bracket so that we put everything on the numerator in bracket, times into bracket 1 plus the growth rate. The growth rate tumepewa ni 3%. Then we close the bracket, divide everything by cost of equity, which is 18% minus the growth rate of 3%. Yeah. So I think this is okay. Then we have a 47. So basically 69 times 1 plus 3, that is times the 1 plus the growth rate. So our growth rate is 3%. Then we divide everything by 18 minus 3%. Yes, I think that is okay. So that is the terminal value. Then now we can proceed to determine the value of the firm. So we can just add this that we have here. So we can add those figures there so that we proceed to get our value of firm. So the value of the firm here would be equal to, we are talked about that NPV. See, we are getting the net present value of our cash flows. And of course, the rate we are using is the weighted average cost of capital, which is 18%, I think. Yes, which is the 18% as our discounting rate, comma, and the values. So the values as per what we have here. So basically, we are using the NPV function. And of course, we said the only difference is that here we will not deduct that initial outlay. Yeah. So that should give us the value of the firm as 41 million. Then we can get the value of equity. So the value of equity would be 41 minus the value of debt, which is 24 million. I think value of debt is given in note 1. Note 2, sorry. The current value of debt is 24 million. So basically 41 minus 24. Then of course, here I can even get the price per share. It should be 17 divided by the number of outstanding shares. The number of outstanding shares from here is 4 million. That is the number of outstanding as 4 million shares. Of course, we are getting a price per share of 4 shillings. Huh? Yes, so we have that as our final result. So I think the other one, the sheet that I had shared earlier, when you look at my computation for the interest, it was a little bit different from maybe the approach we are taken here, because I wasn't very sure how we need to approach that interest computation. So I think that is the only thing that is changing. All other things should remain the same. And of course, the value for that would affect our net income figure. So maybe it may have a slight impact on even our computations here. But of course, this is generally the approach that we need to take as far as valuations are concerned. So unless there is a burning question, we can stop there. We meet on Thursday next week. Unless there is a burning question. So basically from next week, we'll be talking about budgets. Then after budgets, we do tax. So budgets should be done with it next week. Then the other week we do tax. Yeah, so basically next week we should be doing budgets, then we do tax. Of course, as we also push our theory, then we close with groups. Alafu we do the revision some of the past papers as far as this is concerned. Otherwise, let's have a wonderful evening. Then I've also realized some of us don't open the Excel sheets I share in the group. This question I had already shared the answers last week on Saturday. I'd already shared the answers. It's in the sheet that I shared last week on Saturday. I remember well. Maybe like some of us we overlook, or you just want me to share over and over. but I've already shared the responses. Yeah. So otherwise, let's meet. Maybe I can just reshare, maybe for the sake of those who joined later, but it's something that I already shared. Yeah. So otherwise, let's meet later. On Thursday, we do budgets. The other week we do tax. Then after tax, we finish with the groups. Then of course we start looking at the past paper questions that maybe we've not handled as part of our revision process. Otherwise, let's have a wonderful evening. See you on Thursday. Bye-bye.